particularly this week when we got those jobs numbers, which surprised the upside. What did you make of them?
This was a hot report. Jobs above 300,000, upwards revision, strong household survey, hours up, payrolls up at nearly a 10% annualized rate. This was a hot report that suggested that, if anything, the economy is reaccelerating. This is very different from what lots of people, most people, I think, were expecting, and fits the thesis that the neutral rate is much higher than people supposed, and tight money is much less potent than people supposed.
So let's talk about the neutral rate. You've said before that the Fed should have at least some idea of the neutral rate to know whether it's restrictive or not. We heard from Chair Powell this week, speaking at Stanford, where he said, yes, we are restrictive in our policy, and yet he quite explicitly said he doesn't need to worry about where the neutral rate is for policy going forward.
So all those are very important things, but they're not things that affect the longer run potential output of the United States. So honestly, though, so the question of what will be the equilibrium interest rate, the neutral interest rate going forward, doesn't really matter for policy today.
Saying we don't need to know what the neutral rate is like saying you should drive your car on feel without looking at the speedometer. It is just a mistake. You cannot know, and look, I don't know what the chairman said in full context, and I want to be fair, but there's no way to judge what policy is without knowing what would be a neutral policy. My view is that the evidence is overwhelming that the neutral rate is far higher than the 2.5%, 2.6% that the Fed talks about. That evidence comes from four places. First, we have high interest rates, and we have an economy that is, if anything, growing faster than its long-run potential, creating jobs as fast or faster than natural growth in the labor force, even allowing for immigration. Second, we have an economy with financial conditions that are extremely loose, that are actually looser than they were before the Fed started the whole tightening process. If you look at credit spreads, you look at the stock market, suggesting that in the fullness of it all, financial conditions actually haven't been tightened in an appreciable way. Third, if you look at the market's estimate of the long-run neutral rate as formed by looking at longer-term forward interest rates, that neutral rate is comfortably above 4%. Fourth, if you look at the fundamental determinants of the neutral rate, we have big surges in budget deficits that, if anything, look to get worse given the political process. We have big changes in resilience investment, in green investment, in new investment, in data centers, along with deglobalization, which may limit capital inflows into our country. So whether you look at the fundamentals, you look at market estimates, you look at financial conditions, or you look at the current strength of the economy, it seems to me the evidence is overwhelming that the neutral rate is far higher than the Fed supposes. And so cutting rates and hitting the accelerator in an economy creating jobs at a pace of more than 3 million jobs a year, with payrolls growing at rates consistent with inflation far above 2%, with a need to hoard ammunition because we're not 100% certain we're past every financial problem in the banking system, and with potential supply shocks coming down the road, things could change. Things are always subject to rapid change, so I don't want to make a prescription for monetary policy in June. But on current facts and current trends, I think it would be an inappropriate act to cut rates in June. And it is deeply troubling to me that the Fed somehow thinks that fidelity to its previous forward guidance and doctrine it believed some time ago is a more important thing than trying to gauge the neutral rate on an ongoing basis.
There's a lot of talk right now about what we're seeing in the labor market here actually is an increase in immigration. And I'm not necessarily even talking about the people coming across the southern border illegally. I'm talking about legal immigration, which has increased rather significantly under the Biden administration. How is that affecting your model for economic growth in the United States?
Look, that has meant more labor force growth, which has meant more supply. To the extent that those immigrants are earning and increasing the capacity of the economy and remitting the money back to their families where they came from, it's a supply increase without a concomitant demand increase, and therefore it's deflationary. But that's what's been baked in and is going to happen and has been happening. And so the question for movements in inflation is that trend going to accelerate or is it going to decelerate over time? As I look at the attitude, which I find ugly and unattractive, of a potential Trump administration towards immigration, if I look at the political pressures on the Biden administration, it seems to me much more likely that immigration flows are going to decrease going forward than that they're going to increase going forward. And that's just one of the ways in which deglobalization may contribute to higher inflation.
Well, Larry, one of the things you're known for is the peripheral vision, the other things you're looking at that may be worrying you. What other things are worrying you that are out there right now?
David, I'm nervous about oil prices, given what's happening in the Middle East and given the increased possibility that Iran is going to be drawn into this conflict, given that we've got the coming of summer combined with higher wholesale prices projected. I think there's a real shot that we will have gasoline prices back to having a 4 handle. And I think the last thing is that if I'm right, I'm not convinced that duration mismatches in the banking system have been fully addressed. And the combination of duration mismatches plus hot money on the depositor side plus problems in commercial real estate means that we could have some real financial distress at some point. Again, I think it's odds off, but it's a risk. And that's another reason why I think the Fed should be hoarding its ammunition, not pumping up bubbles with easy money at a time of rapid growth and epically loose financial conditions.
Larry, the Treasury Secretary, Janet Yellen, is in China this week talking to them about trade issues. There's a lot of concern about what people, I think the Wall Street Journal may have coined it actually, the China Shock 2.0, because China's built up an awful lot of capacity through a lot of subsidies, and there's a concern about really flooding the markets with really cheap goods. How could that affect the global economy and the U.S. economy?
We've talked about this before, David. Secular stagnation has crossed the Pacific, and China has a chronic excess of savings over investment, and they have to do something about that. The right way for them to have dealt with it was to have stimulated domestic spending but that does not fit, and particularly domestic household consumption, which is long suppressed in China, but that doesn't fit with Chairman Xi's ideological predilections. And so it looks like they're trying to do it by building manufacturing capacity. That runs the risk of everything glut, driven by Chinese subsidies. And I think that's runs the risk of reawakening very substantial economic tensions between China and the rest of the world. What they focus on in China is that this is all smaller in terms of a trade surplus relative to the Chinese economy than it was at the time of the first China shock during the decade of the noughts. What that misses is that the Chinese economy is much larger relative to the global economy than it was 15 years ago. And so a given shock to the Chinese economy is potentially much bigger for the global economy. So I think this is likely to be substantially disruptive. My guess is that we're going to see considerably more protection than most people are looking for. And for the medium term, I don't think that's going to be good for the inflation outlook or good for efficiency of production in the global economy or good for harmony among nations. And the reports coming out about China cyber challenges, deep fakes, intrusions into our data systems, hacking, are troubling. And I don't want to rush to judgment because I don't know exactly what the facts what the facts are. But as I've said to my Chinese friends, as someone who in general has worked to promote comity, who thinks that truculence is an attitude, not a strategy for the United States, the Chinese often seem like they're doing their very best to make it maximally difficult to support comity and to reject Cold War type mentalities.